Hey everyone, it's Angela and Colleen here. We are Homes and Loans. If you have been listening to us, we're thankful that you're back. So this week we are tackling the topic of investors.
Good topic.
Yes, I'm
Yeah.
super excited. There's so much to cover when it comes to investors and basically what people's idea of an investor is. Because I think a lot of people think investing might be like big pockets, Wall
Right.
Street, things like that. And honestly, investing is for anyone, literally anyone. You could be just a regular homeowner and now you're thinking, how can I have some stability and build my portfolio or have long-term goals? And investing is really about strategy. So we're going to talk about that
Right, yeah.
and all the different ways that we can do that. So to start, I think a little background on what we consider an investor for you and I,
Right,
whether you're on the
right.
real estate side or on the lending side. It's when it's not your primary residence, if it's for profit, bottom line. It's a strategy for profit, whether you're going to flip it, do a quick flip, buy and sell and make a profit, or you're planning to hold it long term,
Correct.
different things
Yeah.
like that. Whether you're trying to buy a short-term rental to, you're going to check your rate of returns and
Make sure it's going to make sense for them based on what they can get in rent versus your PITI, which is principal, interest, taxes, insurance, the total expenses you would have monthly on that.
we'll try, if we throw a bunch of abbreviations at you, we'll try to explain them. So ROI, caps, PITI, debt ratios, all those things that come into play.
Right,
So
right.
from my standpoint, I most commonly see for investors, it's one of two things. Either someone that's trying to build their portfolio. So for example, here in Orlando, we've got a lot of great universities and big companies like Lockheed Martin. And so investors will buy homes in those areas because they have great rentals.
Right.
People are always looking to rent in those and they hold them long term and they get a good amount for rent each month.
And all the attractions that we have here. So investors may want to buy what we call an Airbnb.
Yeah.
So that they can do short-term rentals. So, and we have loan products for all of them.
Yeah.
So,
And we're going to jump into that. We want to make sure you guys know which kind of loan product is kind of best depending on the situation of what you're looking for, whether that's like we said, like someone who might just want to do buy a distressed property and then fix it up and sell it immediately. They're not looking for your simple 30-year fixed rate mortgage. They're looking more
or like
for
a fix and flip type loan. Yeah.
So, and that might be hard money. That
Hard
might
money,
be
yeah.
something where you're not giving a lot of income documentation. What kind of loans would we look?
Well, hard money is typically not a lot of income documentation, and there are some what we call fix and flip loans out there, which means it's short term. You have an investor that just wants to purchase a property, fix it up, and then flip it for profit.
So the fix and flip loans, we'll stay on that for a second here. So what's normally the term, down payment, repayment, things like that, interest rates, things they need to know?
That's more on the brokerage side. So I don't typically personally see that myself, but usually it's a short term 6 months to 6 to 12 months.
Really flipping.
And it's usually a quick turn. Yeah. But then if they want to keep that property long term, then we would look at our traditional investment products that we have available.
Do you have a product that starts out initially where they can pull the cash and then it transitions into like a solid 30-year if they don't pay it off within 6 months or anything like that, or no?
No.
Okay, just curious.
No, it would have to be a refinance.
Thinking outside of the box there. Okay, so they can do, and do some of those loans have like a balloon?
So I do a lot of refinances for investors that do maybe hard money because of the condition of the property. You can't get a traditional mortgage.
Yes.
So they'll get a hard money loan, take it out short term, then come to me to do a refinance or a cash out to get some of their money that they put into the home. And then they'll put a long-term tenant, or do it as an Airbnb.
Okay, so a couple things I think are important for people that are thinking about investing, understanding is the income aspect of things, because it normally comes down to that. So normally when you're buying an investment property, it is because you're looking at either the long-term value in it, in building equity, or how much you're going to make each month in your rent to offset what you paid for it and bring in that additional income, or short-term rentals, and again, that additional income you could use. And so what we want to talk about now is how does that affect the loan aspect? How much of the potential rent is then included in their income?
So if you did a traditional investment loan, let's say, and you're buying it to put a long-term tenant, we will use 75% of the rent, what we consider market rent, to offset the monthly payment.
So that market rent is determined by the appraiser. Okay.
Correct.
Okay.
However, there are some investors that want to purchase for an Airbnb, and we do have a report that we can run on the back end based on property address as to how much that short-term rental will receive in potential rental income.
On the lending side of things, if a property is already a rental, for example, it's already an Airbnb, it shows a history for the last 5 years, are they allowed to provide you with the rental history as proof of income, or do you still need the appraiser?
If there's a current lease,
yes,
and they provide that, then yes, we would look at that rent.
For the current lease, but if it's short term, would they be able to show what they made for the weekly short term rentals?
If it's through a property management company and we get a report, yes, we will look at that as well.
So it has to be through a property manager, just so people understand. If you're just planning to do your own Airbnb and VRBO and show the receipts, that doesn't normally cut it. They're still going to ask for the appraiser's opinion on rentals.
But I believe with VRBO and Airbnb, there is a report that they can run.
Submit. Okay, well then there might still be hope for you.
Yeah, so for a long time, the short-term rental income we couldn't really use without a history on tax returns. But now we do have the ability to a couple different options to determine that.
Okay, when you said like a standard investment loan, in my experience with my clients, that usually requires them putting down 20%.
So the minimum is 20%, and then for a regular traditional conventional loan, we're going to base their qualification on their income and the projected market rent.
Okay.
So that would be your traditional conventional loan. Obviously, when it comes to rates, the more money you put down for an investment property, the better your interest rate gets.
And like you just said, you can use 75% of that estimated rental income to offset the debt part of that.
Exactly.
Which is amazing.
Exactly.
And we were just keeping up to date on things as we were walking in. Colleen just got some new news, so I'm going to let her share that on that, which I think is amazing and exciting.
Yeah, so Fannie Mae just came out with an enhancement. So if you purchase a single family property that has what we call an ADU, an ancillary dwelling unit, which it could be maybe another structure on the property, maybe an apartment above the garage.
In-law.
We can now use the projected market rent to help offset the monthly payment.
Yeah, which has never been the case. So if you're familiar with Orlando, there are several different areas, say Baldwin Park, and a lot of those beautiful homes have these amazing
apartments above the
garage with
Avalon
separate entrances, and they rent them. And so up until now, they weren't able to use that income to offset it when purchasing. So that's great news. And I had another one, same thing. It was downtown Orlando, and we had the hardest time getting a buyer for it because it was like they had this separate apartment. So now you could take the income for that separate apartment.
That's definitely a great enhancement.
Yeah.
And if you can't qualify with your traditional conventional products, we do have other products available. The most popular, I think, right now is what we call our DSCR, debt service coverage ratio program, where the minimum down is 20%, and we use the market rent to offset the mortgage, and we can use 100% of that. So let's say your mortgage payment is $2,000. We have to be able to have market rent at $2,000. So you have to meet 100%. So basically, everything hinges on the market rent.
Rental.
There's no income verification. We just verify your assets for closing. And let's just say with higher rates now, if it doesn't quite meet that 100%, we can go down as low as 75% of the rent, but the interest rate's higher.
Okay.
But sometimes if you take a 1 or 2 year prepayment penalty on those, the interest rate's really not that bad.
So if people don't understand, explain the prepayment penalty.
So there's different investors have different prepayment penalties. It could be 6 months of interest. It could be 5% if you pay off your loan within that time frame. So 1 year, 2 year, 3 year. I just closed one where the investor took a 1 year. Anything maybe more than that. If rates come down and you want to refinance, then you're going to have to pay that penalty.
Yes.
So you got to be cautious as to how long you take that prepayment penalty for. So.
But again, that brings us back to the whole, on a loan like that, are you still allowed to do a recast? And I know we're going all over the place here, but No. Okay, good. Because I was going to ask, because here's the thing. For my clients, generally, if they can get a better interest rate by taking a 1-year prepayment penalty, I tell them to, because if I know their long-term goal is not to do anything with this property for the next at least 3 to 4 years, then it's worth it for them in their monthly payment.
They don't allow recasts on investment properties.
But that's what I wanted to see. Because like you said, you have to be cognizant of it if you're thinking interest rates might want to go down and then you're going to want to refinance. But
correct.
My thought was, well, you might not want to refinance if you can recast, but you can't recast on investment property. So it's just only on a primary residence.
Yes.
Okay. Which is another great thing. So.
It is. I have a lot of clients that.
Do you find that a lot of investors use the DSCR loan? Because I've heard a lot about it, but I've never had an investor use it.
I would say more of my clients do the DSCR loan versus a traditional conventional loan.
Really?
Yeah.
So is there a difference in the qualifying credit score, or the down payment is the same, still 20%?
It's still 20%. I think the minimum on that program is $660. But obviously,
you should have that anyway, I would think.
Well, the lower your credit score is, the higher you're going to pay on the interest rate.
Yeah.
But if you have good credit, I mean, right now, I think the other day I quoted one, it was 6.99 on the DSCR with a 1-year prepayment penalty, which is pretty good.
No, I think that's good for an investment loan in the current market. I mean,
100%.
We're in October of 2025, people. So investment loans at under 7 is
100%. And again,
looking good.
I had somebody doing a 1031 exchange where they're selling one investment property to purchase another, and he had to roll that into a new one. So I think it was like 40% down, and his rate was 6.5%.
Yeah, that's really good.
So the more money you put down, the better your interest rate's going to be. It's just investment, and it's just to protect them from paying the capital gains from the sale of that home. And then you have a certain period of time that it has to go into that third-party account.
That intermediary.
And then is it 90 days? Or
it's a very short amount of time.
I think it's 60.
Another thing I learned in doing a 1031 with an investor previously was, normally you think, if you're selling a property for $1 million, you have to spend at least $1 million on the new property that you're doing the 1031 exchange for. So you're taking the funds and applying that.
And you have to apply all of the funds.
You have to apply all of it. But I did see a scenario where they were able to take all of the funds, but they split it between 2 different properties.
Yeah, you can do that.
So as long as cumulatively it value is, the
Correct.
purchase price is more than what you sold for.
Correct. You just cannot touch that money. It has to stay in that account until you do that
purchase.
So
they used it to put half on this one and half on that one and purchase 2 new investment properties.
Again, it just has to be done within that certain time period, and you cannot touch those funds.
So again, this all kinds of goes back to, it's all about strategy. Because you're hearing us throw a lot of things at you, whether it might be, investors, different properties, DSCR, standard investment loans, 1031s. But again, you really have to have a plan. You have to tell us, me, your agent, like, okay, I'm looking for a great location or best rate of return, or where I can do short-term rentals. And that is also a whole nother can of worms, because it's very specific to location and county and laws. Okay.
Right.
And then on Colleen's front, based on what we're telling her, or any lender that you're working with, basically, I mean, that's how they're going to figure out which product is going to be best for you. Like, if you don't want to show your income docs, but you got great rental, income on it, you could do the DSCR. Or if you have a property to sell and you want to just roll it over and not pay taxes, you want to do the 1031.
Right. Yeah. And so when we qualify somebody for an investment purchase, obviously we got to look at total expenses, right? Mm-hmm. We got to look at the HOA, we got to look at taxes. And let's just say they buy something right now that's got homestead exemption. So we got to factor in the fact that the taxes are going to go up. So that's where you come into play. And you can tell me, okay, what's market rent, so that we can make sure that the investor is getting a good rate of return.
Yeah.
So
that's generally the most important things for investors. So if you're thinking about being an investor, again, you're looking for us to tell you, like, okay, this is a great area as an agent, send you comps, tell you if it's up and coming or what is being developed around it that might increase the value over the next few years, because that's super important, because you might only hold it for 5 years, but obviously you want to make money during that time, gain equity, and then turn around and invest that in another property, or pull out money from that to invest in another property.
Else,
I have a lot of clients that Colleen has personally worked with, and they buy an investment property. They have it for a
Multiple.
year or two. Yep, they buy one after another in the same location area because they work for them, and then they pull the equity out of that to buy another one.
Yeah.
So now it does get a little complicated because, as Colleen will tell you next, you are generally capped, and the rules change the more properties you have. So can you tell us a little bit about that?
I believe it's up to 5, and after that, then you have to put a little bit more money down for a maximum of 10. So we have other investors too that we can broker out that allow more than that. I know with like certain programs like the all-in-one we've talked about, I think the max you can have is 3. Yeah. So each program has their own, guideline as to how many loans you can have.
Yeah. Interesting
on that particular,
stuff.
yeah.
So, I don't know. What do you think? What questions do you have? We need more questions from you.
From your perspectives, have you seen the average age of investors getting younger and younger? I feel like it's becoming some of that. My generation, even younger, is saying, you know what, I want to do this as opposed to being, dad or grandfather.
Oh, you just reminded me of a great story. Okay, so I will say I do. There are always going to be people that have been ingrained to invest in properties, and that's amazing. I think it's a great long-term plan. It's a great retirement plan. I know people that buy a house every year, every couple years, because they're putting together their portfolio, and then they want the renter to pay it off, and then they want to just receive that income when they retire, right? Have all these properties, or they'll sell them all, invest in the stock market, whatever the case may be. But that is a great long-term plan.
Absolutely.
Great long-term plan. What I am seeing now is I find I've been having new first-time home buyers who don't own their home yet, but they're not ready to do that. They want to buy their first investment property. So, which is super interesting.
Yeah, and there are several programs that don't allow that. If you're a first-time home buyer and you want to buy an investment property, there's several programs that won't allow first-time home buyers.
Really? Like what? Oh, you mean like for the down payment assistance, or
for DSCR? So
you can't be first-time home.
I think there are some investors we can find that will allow it, but most of them will not.
Yeah.
Because if you haven't owned your own home, you don't really know what all goes into, with the expenses of purchasing a property. And what if something breaks? The tenant's going to call you to get it fixed. And
I think the other thing is most savvy investors know that they're going to have that 20% down. And most first-time buyers generally only have that 3 to 5% down. Right. And so you can be competing on a property that might be a great investment property, but you're going to be competing against an offer that's likely cash or going conventional.
Correct.
And so it's hard for you to compete for that as a first-time investor, first-time buyer. You're asking for closing costs, right? Because investors generally don't do that. They're just going to...
And you're capped at 2% on those.
So you're capped at 2% anyway for asking for closing costs.
But the interesting thing, talking about a first-time home buyer buying an investment property, if you buy an investment property and you never move into the home, and you still want to qualify as a first-time home buyer under programs, you are still a first-time home buyer.
Oh.
It's occupancy.
Okay.
You can't occupy a property as your primary residence.
That's what takes it off the board, is if you occupy it. So if you never occupy it, you can still use your first-time home buyer advantages.
Because I've had clients that maybe their parents put them on the deed, or they purchase a piece of land or whatever, and they put it in their child's name. As long as you've never lived there in the last 3 years, you're still considered a first-time home buyer. Yeah.
So even if you did live there but not in the last 3 years, you're still covered. So that's a good point as well. Anyway, I know we covered a bunch of different things when it comes to investors, investing, the different loans, the different products. And so you might feel a little confused, but if you want to learn more about these, please reach out to us. We're happy to answer any questions, whether it be, you're thinking about investing for the first time and you want to know like areas, returns, things like that, or you want to know what the requirements are. Colleen can tell you, but we want to hear your questions. So please keep listening, follow, like, and we'll see you next time.
Thanks. Have a great day.